Hi class, welcome to our American Barrick presentation. In this slide, you will see the four phases of the value chain for gold producers: exploration, acquisition, develop, mine, process, and sell gold. Gold mining businesses face many challenges. One of the biggest challenges is finding and processing gold. American Barrick had great fortune with the sites they chose because they were producing more than they had anticipated. The Gold Strike mine is an example of competitive advantage. Quoted in the text, the ore in American Barrick's Gold Strike mine contained an estimated 0.127 ounce of gold for each ton of ore, meaning a single ounce of gold might sell for $300 to $400. And that is why they were very fortunate on the sites they had chosen. American Barrick acquired their gold mines for lower prices than the competition because they were able to finance mine acquisitions even with declining gold prices. The other firms, on the other hand, did not have the option to finance when gold prices were declining, and this gave American Barrick a huge advantage in production. The hedging program kept a great inflow of cash, and this was the whole intent of the hedging program. With hedging, the firm was able to manage gold price risk. Even if gold prices were to fall, the firm would still profit. And by doing so, it was rewarded with great cash flows and it maintained a strong stock price. And it earned benefits when gold prices increased. Investors were attracted to American Barrick because the hedging program stabilized earnings. Even if prices of gold were declining, investors did not hesitate to invest. Barrick was able to develop, mine, and process gold at very low costs. When the cost of gold had declined, it was cheaper to produce gold. This allowed them to have an advantage over other mining companies. As producers of commodity products, gold mining had virtually no marketing or distribution costs. There was always a ready market for their product at market prices once extracted from the earth and refined. Therefore, a gold mine's profit were a function of the quantity of its production and the difference between the prices at which it sold its outputs and its cost. American Barrick had no competitive advantage selling gold because the market determined the price and the product was very similar to other firms. The hedging program seems like a selling competitive advantage, but all mining companies could have made the same hedging deals but chose not to.
Peter Monk, he is a successful entrepreneur and financier. He is the CEO of American Barrick. He had no prior experience in the gold mining business. In the early 1980s, Monk sensed a demand by European and North American investors for holding gold stocks without the political risk of holding South African investments. Financially conservative and was insistent on bearing low financial risk. Past failed business attempts caused a high distrust of highly levered business strategies. American Barrick faced the exact same risk as others in the commodities world, and those are political risk, supply risk, economic financial risk or inflation, operational risk, and strategic risk. American Barrick's hedging strategy over time. In the early 1980s, Barrick's earliest efforts involved gold bullion loans used as currency to fund mine acquisitions. They were repaid with gold from their production. In the Barrick Coalition Gold Trust, paid investors a percentage of gold output given certain gold selling prices. This was the early days of Barrick's gold financing. In the mid 1980s, they began using call and put options in forward sales. The forward sales in 1984 and 1985 significantly reduced the upside earnings, which led the firm to utilize more collar bull straddle type strategies in the late 1980s. In the 1990s, they utilized less call and put options and focused primarily on forward contracts. This finally evolved to spot deferred forward contracts being the primary vehicle of financial hedging. We will discuss the three most recent hedging strategies used by American Barrick and why they were used, how they worked, which risks were mitigated or completely avoided, and the advantages and disadvantages of each individual strategy. The specifics of forward contracts. The company's profitability was in decline as gold prices dropped to break-even levels. The sharp drop in gold prices in 1984 and 1985 led AB to sell its first explicit forward contracts. Forwards are a contractual agreement to sell a specified amount of gold at a specified price on a stated date in the future. This was only effective if the price of gold dropped, which happened through the early 1980s and again in the early 1990s. However, when prices rose in the mid 1980s, forwards were very costly for the firm. Price risk was completely mitigated by forward sales. However, the upside was completely abandoned as well. Forwards did allow the firm to stabilize earnings regardless of gold value. While stabilized earnings were crucial to investor confidence, the loss of upside profit caused the firm to consider other strategies, such as options and spot deferred contracts. How the strategy improved upon the previous strategy. Forward contracts provided more stable returns but still a great cost to upside potential.
Next, we have the option specifics. Call and put options were used to try and capture more of the upside from rising selling prices while putting in place a price floor for losses. They could purchase put options to benefit the firm when the price of gold dropped below the strike prices, or they could sell call options to protect the upside earnings when gold rose above strike prices. This created a window around current gold prices where Barrick could capture all of the value of their gold sales, virtually mitigating all of the market risk. Some disadvantages were the inability to write options for only a short period of time, typically within a few years. This option strategy was much more effective than gold loans, giving them flexibility they had to work with the ratios of puts and calls to create a larger window when they could guarantee their profits. We now have the final solution, spot deferred forward contracts. American Barrick needed a way to profit from increases in the price of gold and to set a minimum on its sales of gold. Spot deferred contracts gave them this solution. Spot deferred contracts had multiple delivery dates where the seller could choose which of these rollover dates to deliver the gold. If the price rose, they could defer the contract to capture the price increase. In 1993, American Barrick completely abandoned the traditional forward sales for spot deferred contracts. The spot deferred contracts gave the firm the ability to capture the results of the option strategy, but to sign contracts that had multiple year durations. This allowed the firm to stabilize its earnings well into the future, maintain a price floor for losses, and capture the upside potential should the value of gold increase. Here are a couple sources of American Barrick's superior performance. Focus on stabilizing earnings, which was a conservative financial strategy, a willingness to give up profits to maintain investor confidence, maintaining a consistent strategy, a significant corporate ownership of the firm, and a policy of mining and producing as much gold as quickly as possible so that production decisions were not affected by the market price. What if the price of gold had increased throughout the 80s and 90s? We came up with these two scenarios. If the price of gold had increased and hedging had not reflected this increase, then American Barrick would have lost significantly. They may have maintained their investor confidence, but at the expense of huge profits, which in the end would not have made the investors very happy. If the hedging strategy did capture the rising gold prices, the firm would have captured those profits as well as maintained their investor confidence. In the 1990s, the Mako mine came with 0.8 million more ounces of gold than anticipated. Ultimately, Monk and his team decided to hedge this entire excess amount and were asked to determine if this was a good decision. In an industry with many competitors who are mainly focused on the short-term profits found with short-term rises in gold prices, the stock prices tell a different story that reflects the volatility of gold value. American Barrick had a competitor that hovered around $1 per share throughout the 80s and 90s, whereas American Barrick, through their strategies, continually rose to above $6 per share. This is attributed to the stability of earnings that resulted from the hedging strategy. For these reasons, we think that hedging the full amount was a good decision. In 2012, investors no longer valued the hedging program and it was abandoned. Shortly after, the share price fell. What does this say about the risk management program? This makes the point previously stated that investor confidence was a direct result of the hedging program. The gold market is intrinsically volatile and investors do not like volatility. The risk managers at American Barrick were able to transform their firm's earnings into stable cash flows. Without the hedging program, this was no longer possible, and with the decline of gold prices, investor confidence went with it. We are here to identify that one of the main roles of a risk manager is to stabilize earnings and minimize volatility where possible.